Then the next transaction is on March the 30th. Here we're going to sell the remaining 1,000 treasury sales, but this time only for 14,000. Well, what happens sometimes is when we start selling this treasury stock, sometimes over time the price of the treasury stock goes down. Now when I do this journal entry, I'm going to debit cash, but I'm going to skip a couple of spaces there and leave myself some extra room, because this one is not going to work out quite so nicely. So this time I'm selling the treasury stock, 1,000 shares. It said I'm selling it for 14,000. So I can debit cash for 14,000, but for that other 1,000 shares, remember my note up here of 17, I had paid $17 a share for that. So that's $17,000 in my treasury stock. Well, the problem there is evidently the market price of the stock fell. And since the market price is falling, they decided to go ahead and sell those extra 1,000 shares before it falls any lower. But you see that we have a discrepancy here, and it's a discrepancy of $3,000. Now, normally what I would do is simply take that from the paid-in capital. Problem is I don't have enough in my paid-in capital on the treasury stock. Right now I've only got $1,000 there. So part of this difference I could debit paid-in capital treasury. That'll cover $1,000. Unfortunately, that's not enough. I'm going to have another debit of $2,000 to make up for that difference. So since I don't have enough money in my treasury paid-in capital, where am I going to dip into to find that money? I'm going to have to, unfortunately, dip into my retained earnings to cover that. So sometimes we have to do these things that are a little bit complicated simply because we didn't have enough. Now, a lot of people would point out, if you go back to the very beginning of the problem, they actually have 44,000 in paid-in capital, but that's paid-in capital on the common stock. That's not on treasury. So you want to be able to differentiate there. So that'll take care of that transaction on March the 30th. Now the next transaction, April the 1st, declared and paid a 50-cent per share dividend payable on April 30th to the April 15th stockholders of record. Well, we had a transaction very similar to that earlier on in the problem. So we know exactly what to do. We know the money comes from retained earnings, and that retained earnings has to be debited, and we're obligating ourselves to pay that dividend, so that is dividends payable. But the question this time is, what about the amount? The amount's going to be a little different. Last time I used 9,500, but this time I have to ask myself how much stock is actually out there. Well, we have to go back and think about that. Initially, we said we had 20,000 shares issued. Then we issued an extra 1,000. That took it up to 21,000. Then we bought 2,000 back, which took it down to 19. But then we sold 1,000 and then sold another 1,000. So now all the stock is back out there. So now we're actually at 21,000. So it's going to be a different amount this time. It's going to be 21,000 times 50 cents. So this dividend is actually going to cost $10,500. So you always have to go back and double check on that, because you want to know exactly how much stock is out there. The next transaction is on April the 30th. They paid the dividend declared on April 1st. So this is very easy to do. This is just simply the payment of that dividend. So we can handle that. That's not too bad. 10,500. We are settling the liability. So the liability is gone, and how will we pay for that? With a credit to cash, which lowers the amount of cash. And then finally, the last journal entry is on May the 1st. And at this point, they issued 1,000 shares of common stock, but not for cash, in exchange for equipment. And the equipment is worth 18,000. Well, remember in our video that we did, our video lecture on common stock, we said that sometimes they do actually trade stock for other assets. And if another company has an asset that we want, And if they're willing to take our stock in exchange for it, we can certainly do that. So this equipment that we traded for, well, it's now our equipment. So we'll debit that as an asset to record that. And what are we issuing? Common stock. So we'll credit common stock. Now, the equipment, it says that it has a value of $18,000. Now, how much stock are we giving them? Well, according to the transaction, we're going to give them 1,000 shares. Well, remember, I always use the par value on common stock. The par value of that stock is $10,000. So that's an extra $8,000 in value. Where's that extra $8,000 going to go to? That's going to go to my paid-in capital. So that completes the transaction for May the 1st, and that completes this example on corporate stock.